Hi everyone, and welcome back to another real estate market update for Walworth County, Geneva Lakes area. And today we're really going to focus on what to expect in this upcoming holiday season from the real estate market. So as usual, I'm going to start from the macro level, then chunk it down to our actual local market, and then chunk it back up to what it all means. So I won't spend a lot of time in the macro in this video because we covered it extensively in previous videos, but I'm going to be touching on brief overviews of it. So according to the National Association of Realtors, we are 5.5 million housing units short on a national level. And here's why. So if you look at this graph, this is housing production, and we haven't kept up with the pace of population growth. So leading up to the housing crash, we had this nice big run up of housing production, and then it pretty much stopped and crashed because what happens is when prices drop the way they did, it's no longer profitable to build. Now you can say, hey, well, Jay, we're picking back up again, which is true. You're right. But the pace of pickup that we've seen isn't enough to keep up with the demand we already had or had in place, and the growing population. So therein lies the issue. We're just not keeping pace with population, and this shows supply. Supply has been decreasing steadily since the market crash, while our population and demand has been increasing steadily. All right, so let's chunk it down to our market. We're going to only cover 4 metrics because the others are pretty much staying the same, and I don't want to repeat for you. So months of inventory, just a brief recap. So if we got no new listings on the market as of today, how long would it take for buyers, our market of buyers, to absorb all the homes that are on the market right now? As it shows, about between 2.5 to 3 months. So last month we were at 2.73, but this month we're only at 2.8. So in a theme that we're going to see in this video is that the rate of change is more important than the change itself. So what happened? So coming down, we accelerate into the seller's market. We had the lowest inventory, record low of inventory that we've had in a long time. The seller's market peaked between January and April timeframe, and then we saw a rapid acceleration in the other direction. Now anything below 4 months indicates we're in a seller's market, and we're rapidly accelerating out of it. However, between August and now, you see the rate of change decrease. So what does that mean? It means we are still in a seller's market because we're below 4 months, and it shows that we're likely to stay around this level, especially going into the holiday season, because real estate is cyclical. People want to move in the spring, summer, fall when it's nice out. Not as many people want to move when it's snowing, cold, or icy. So that's what we're going to expect. We're going to expect around 3 months of inventory and for that to plateau. All right. This is a very important slide, the sale price to original list price ratio. So what happens here is if it's above 100%, that means homes are being sold above what the original list price is. And that's what we saw during that feeding frenzy of the seller's market earlier this year. However, if it drops below 100, that means properties are being sold for less than the original. So it peaked in May, and then it rapidly accelerated until August, and then dropped severely in September. And in this month though, you see the rate of change has slowed. So what does this tell us? It tells us that the market, as far as listing prices, has hit a sweet spot. So the sellers are finally realizing that they can't list their homes for these really high, crazy prices. Now they're starting to list at fair market value. So that's why we're seeing that rate of change. And again, this is likely to continue and level off because we've hit that sweet spot in market price and value. All right, median prices. This is actually a confirmation of what we've been seeing from the other indicators. So in September, we were pretty much around the same median prices in February before it hit its all-time peak. But now it was coming down, which was cause for concern for, are we heading to a market crash? Well, no, we can't, because fundamentally we are 5.5 million housing units short. And this month, you see a rate of change difference. It's slowing down, it's leveling off, again confirming that we're likely hitting that sweet spot in median prices. It may drop a little bit more, especially in that holiday season when demand softens, but it's not likely to be a drop like it was in the housing financial crisis. All right, days on market. This is really good for us. So as you can see, the average days on market has been oscillating around 40 days. Now, this month, we did have a bit of an uptick, which is fine, that's healthy, but we're still showing that demand is real, demand is strong. If it was going up at an exponential rate, that's when you know that buyer demand is really softened. But it's staying around that 40 days on market. It's likely to increase just a bit, again, because we're going into the holiday months, and buyer demand is going to slow and seller activity is likely to slow a bit. So this is nothing to worry about. We're holding strong, so that's really great. Now, just to recap, I'm not going to go into all of them into detail, but why is demand softening? So Open Door did a survey, and they found several reasons why. One, the uncertainty of COVID, which continues. Two, the market was intimidating. This is much less so now that we've found the sweet spot in our area. So we'll likely see this reason dropping off. However, supply is tight, hence why we're still in the seller's market. We're still short by about 5.5 million. So that is going to be a reason that's going to continue. Another one is, after people sell, where are they going to go? The shortage is everywhere. It's nationwide. So that's something that's giving potential sellers pause. And the next is, there's been people that they've put out bids and they've lost, it's really emotionally and psychologically, just demanding. And they can get tired, and there's a lot of buyers that just might want a break, and especially with the holiday season. All right. Real estate is seasonal, so we're likely to see a decline in activity coming into the holiday season, which is absolutely normal, by the way. All right, what does this mean? Okay, so conventional advice, if you're a seller, is going to be, hey, the buyer demand is going to pick up in the spring season. That's when you want to list. But think of it like this. All the other sellers are thinking the same way. They're thinking, okay, I'll just wait till the holiday season. However, if you want to start the new year fresh and not have to worry about this is actually an optimal time, because conventional wisdom is, why don't I just list in spring? Because that's where demand is going to be. The people that have to move in this time frame, they still have to move. The people that have wanted to move, they still want to move. So that demand is still there. And if you want to stand out while it's going to be even scarcer coming into this holiday season because seller activity is going to drop, this is your time to shine if you're okay with selling in the winter months, especially if it's a second home. This isn't a big deal. This is going to be a great time because of that scarcity factor. When spring comes around, you're going to have a lot more competition. So something to think about, pros and cons there. Okay, because again, I keep saying this, but because we're 5.5 million units short, we're not looking at a housing price bust because demand is real, demand is strong. We're just going to see a seasonal effect of some softening. Okay, if we were close to 4 months or above of months of inventory, that means we're in a neutral market. We're nearing that threshold, but we're not quite there yet, so we're still in the seller's market. That's likely going to continue into the next year, again, because we're short of homes. All right, if you're a buyer, this is a really great time to be looking because, again, prices have normalized. They've hit their sweet spot, so we're not going to see these crazy bidding wars like we saw earlier in the year. Now, some wild cards. I dug deep into this in our last video, so I'm just going to highlight them. Money supply, that's a huge thing. The Feds injected an enormous amount of money into the market when COVID hit. That is likely to have some ramifications. The magnitude of that is yet to be seen, and the main ramification is going to be inflation. We've already seen it this year, but are we going to see those crazy inflation rates that we saw around the 80s because of what the Feds did with our money supply? They're playing with forces, huge market forces at a national level. They're experimenting. So this is something to just keep an eye out on what's going to happen with that. COVID, with the Delta variant, it's still a wild card as usual. And interest rates, less so, because the Feds aren't going to increase interest rates until they end their bond buying program, which is a multi-month endeavor. So we're not going to see the Feds increasing interest rates anytime soon, no matter how much they talk about it, until they end that program. All right, I know this is a video, but if you have any questions about what we talked about or what we haven't talked about, go ahead and reach out to us. That's my email. And if you're looking to buy or sell in Southeast Wisconsin, my partner Chris, he has been in the market for about 31, 32 years. So he knows the area, he knows his stuff. He's a great guy to work with. That's his email, that's his number. Go ahead and give him a call, and he'd be happy to help you with just a no obligation consultation. All right, so from all of us at the Legendary Real Estate Services team, thank you so much for stopping by, and we'll see you next month. Thanks and take care. Bye now.